is with us here on Wednesday afternoon, the 25th of April, to review the end of our first quarter and talk about what we see going on in the quarter coming and how we got to where we are. The agenda that we'll cover is a review of the first quarter, the investment outlook with respect to what we see going on now, and our portfolio positioning, what we are taking away. Why are you touching my elbow? Pardon me? Do you want me to continue? Okay. The key takeaways that we got from the first quarter, obviously we saw that stocks and other risk assets jumped sharply. 12%, I think, was the growth of the S&P in the first quarter. We saw emerging markets bonds rebound very well after a somewhat disappointing 2011, and we saw dividend payer stocks trailed the S&P after outperforming in 2011. But as a whole, the S&P earned a total return of about 12% for the first quarter. Rising Treasury yields resulted in the first flat quarter returns for core bonds. So there wasn't much that went on in terms of total return in the bond market. Obviously, as interest rates rise, principal values decline, and to the extent that they decline more than income comes in, you have an overall negative return. Our individual bonds, particularly corporates, though, largely did very well. Because of longer-term risks, our portfolios continue to be underweight stocks and lowered equity risk, and core bonds, because of interest rate risk, are also being very carefully watched at the moment. The drivers of the October to March stock market rally after the market got hit hard during the third quarter of 2011, there was a successful intervention that took the European financial crisis off the front burner until fairly recently, that is. Within the last 2 weeks, I think the question about Spain's ability to be able to clear out its banking system, as well as Italy's, is again on the front burner. Positive U.S. economic data continued to come over the period of the October to March timeframe and bode very well for the growth of the stock market. There was encouraging results of the Fed's recent banking stress test. There was nothing in the form of immediate action that needed to be taken, and as a result, stocks had decidedly very strong gains over that period of time. With respect to what the outlook is now for the markets going forward, let me turn this over to you, Steve, and you can pick up where I'm leaving off.
Good afternoon, everybody. Let's start with what's going on in Europe. John highlighted real quickly that part of the reason that the market had a nice rally from the fall through the first quarter had to do with some renewed confidence in Europe. At least maybe confidence is the wrong word. It's more the case where they are taking some steps to avoid the immediate danger of default. And essentially what happened is the European central banks came out with much-needed liquidity for the banks throughout Europe. And this allowed some confidence to come in. This also has the effect of driving government bond yields down in the European countries, which affects their borrowing costs. Essentially, the problem in Europe is too much debt, and if the cost of carrying that debt is too high, it creates too much of a burden on the country. So with these refinancing and other stimulus agreements, some of that risk was taken off the table, at least for the near term. We have some concerns about whether this is a permanent solution, and clearly it's not. It delays some inevitable tough measures that each country is going to have to do over there in Europe. And should that occur, I think Europe will muddle through a mild recession. if their governments are not able to make the necessary cuts to their debt, this is a problem that could recur in the future, and it's something that we have our eye on. In terms of the longer-term risks in the U.S., what we are mainly focused on has to do with not near-term concerns. The recent economic data, particularly in the jobs market, has been more positive than expected, and so that's a good thing, and that also helps help the U.S. markets rally. But our concern is more focused towards the end of this year into next, and essentially it boils down to what one Fed official called a massive fiscal cliff of large spending cuts and tax increases, which are scheduled to occur in January 2013. Essentially, the tax cuts initiated during the Bush era, there's a temporary payroll tax cut, and there are extended unemployment benefits. They're all set to come off the table in January. In addition, $1.2 trillion of automatic spending cuts will kick in if the government isn't able to make some important measures. So the net of this is that should all this occur, which we would consider unlikely, but it's a risk, this would have a major impact on the U.S. economy to the effect of 3.5% slowdown or decline in gross domestic product. So that's something we certainly have our eye on. In terms of how we are positioned for the future, as John mentioned, our core bonds, we don't believe, you can go to the next slide. The core bonds, we don't believe are priced to generate very attractive returns. So therefore, we are not actively investing in the Treasury market or the long-term side of the bond market. Quite honestly, the interest rate risk is too high and the returns are too low to justify that risk. Instead, we're favoring bond ladders. And many of you see in your portfolios corporate and municipal issues laddered between 1 and 5 years, sometimes slightly longer. And this has the ability to generate some income, provide some safety, but also avoid any of that interest rate risk that we're concerned about. We also have some actively managed bond funds that have a very flexible mandate, and they have historically been able to weather rising interest rates, and so that's why they're in the portfolio as well. In terms of stocks, the rally has been great, but the way risk and reward works is with this rally coming now, it actually reduces our long-term expectations for stocks. Essentially, we think a lot of the gains that we expected over the next 5 years have been recognized now, and therefore over a 5-year time horizon, the returns from here aren't overly exciting. And again, the theme is, will the returns be high enough to justify the risk or the volatility that is inherent with stocks? And while we are not giving up completely on stocks, they are a major part of all of our portfolios. We are slightly underweight what we would normally be in terms of stock exposure. Now, as you all know, what we're talking about is essentially the broad market indexes. Well, part of what we try to do is to recognize opportunities, tactical opportunities, to deviate from those broad markets and generate some returns above and beyond what the broad market indexes can produce. And the areas that we're focused on currently and have been for a while have to do with emerging market bonds. This is still an area that we think is attractive for a number of reasons. One, the income is attractive. 2, credit quality is improving in the emerging markets. And 3, because the majority of the bond funds that we use for this are denominated in foreign currencies, these funds also act as a hedge against the dollar decline in the U.S. In terms of volatility, the last 6 months, with this market rise, a lot of the day-to-day, week-to-week volatility has come out of the marketplace up until recently. We think, unfortunately, this is not going to be the case going forward. We do expect volatility to return in the marketplace, and over the last 2 weeks, You've seen it with drops down, and then in the last 2 days, a strong rally up. The good thing about this is volatility brings opportunity. Volatility, strictly on the downside, can create excessive fear, which creates valuation advantages to certain asset classes. So if that volatility kicks in again, we expect to be remain nimble and shift the portfolios accordingly. This chart just shows, in terms of historically, what stocks represented by the S&P 500 and bonds represented by the aggregate bond index, historically what they have done. That's indicated in the blue, and the red are our base case scenarios for the next 5 years. So as you can see, in terms of the broad market indexes, we're not expecting a lot of upside from here, and that's where tactical opportunities come in. That's also where we hope to add some value and exceed those returns. This just talks specifically about the stock allocation. Both U.S. and developed international markets, returns aren't expected to be all that exciting. Emerging market stocks should have higher returns. We do have some emerging market stocks in our portfolios. We added them early in the first quarter. The downside of emerging market stocks is the volatility associated with them. So we didn't make a large bet in that sector, but it's an area that we hope to increase over time. And should we go through a sell-off in the market, that's an area where we would likely add to. Again, I highlighted this earlier, but periods of short-term volatility, that plays right into our strategy of trying to recognize value. So if certain areas that we like emerging market stocks, sell off and the price becomes more attractive, we're ready to use some of our cash or shift some money out of some safer assets into emerging market stocks. There is a big demand among many of our clients for income. And with yields low in the bond market, we're having to go beyond just traditional bonds to enhance income for clients. And some of the things that we are using right now include master limited partnerships, various option strategies like covered calls, real estate investment trusts, and floating rate preferred equities. I'm not going to go into each of these specifically right now, but it is something that if you have interest in learning more, you can certainly give us a call. We'll be happy to discuss whether these securities are appropriate for your allocation. On the bond side, again, returns, and it's just a matter of looking at what yields are offered in the bond place right now. They're not where they were 10 or 20 years ago. Our individual ladders are serving their purpose, which is to provide safety and avoid interest rate risk. We find the value in the marketplace, and John, if you've spoken to him, he firmly believes that going a few notches below treasuries in terms of credit quality is where the value is in the marketplace. So the bonds that the individual bonds that John is buying on the individual, corporate, and muni side, they're all investment grade quality bonds. We do believe in them, but the ratings are a little bit below treasuries. So you will see a little bit of headline risk in some cases, and by that I mean they will move somewhat if risk comes out of the marketplace. But again, high credit quality and the yield that you receive on them is far superior to treasuries or other AAA rated issues. Flexible and absolute return fixed income managers. Many of you see these funds in our portfolios. What's attractive to us about these funds is that they are very wide-reaching. They have expertise in certain areas of the bond market, and they have the scale to capture attractive opportunities throughout the globe. And historically, the funds that we've used have done a very good job of generating nice, sustainable income when interest rates are rising or declining. And in terms of inflationary pressures, the near term, it certainly doesn't look like inflation is a concern, but as you extend out your outlook towards our 5-year period of time, we think it is a major concern, and so therefore we're still focused on that. The next few slides just talk in general about the role of bonds in a portfolio. And traditionally, why do you own bonds? You own bonds because they are less risky than stocks. You own bonds because they can provide protection against major economic shocks or recession, and they generate current income. So historically, if you want to invest in bonds, it's a great diversifier for a stock portfolio. And by combining stocks with less risky bonds in the portfolio, you have a nice diversified portfolio. The main risks inherent with bonds have to do with credit risk, so will the bond pay or not, and interest rate risk. Right now, as I just mentioned, we're willing to assume just a little bit of credit risk. We don't want to assume very much interest rate risk at all, and you'll see that in our portfolios. That's how we're positioned right now. This slide really brings to the forefront what we're talking about with the low yields that are available today. To the right of the screen is the real 10-year Treasury yield, and you can see it goes back several decades, and we are really, really towards the bottom of that range, well below the average real return for Treasuries. So clearly, this is not the time to be making a major bet on Treasuries. When interest rates do rise, the value of these Treasuries will get hurt very poorly. We really like our individual bonds and the flexible managers, the tactical bond funds that we use for exactly this situation, where we can get a little bit excess yield but not expose ourselves to declines resulting from rising interest rates. And another area of our portfolio, which you may have noticed we haven't been increasing over the last year, is what we're calling alternative investments. And the role of alternative investments is essentially to take some risk off the table from traditional stocks and bonds, and to try to generate some return that is not dependent on stocks and bonds going up. The main way we've done this, it has to do with arbitrage funds. There's two main funds that we use in our portfolios. Essentially, these are designed not to make a ton of money, but to generate mid-single-digit returns without a lot of volatility. They are essentially taking the place of bonds in some respect. We think they'll outperform Treasuries over the next 5 years, and they will do so with much less volatility than the stock market. The other advantage of these types of funds is because they are very liquid. If we do want to get more aggressive, it's an easy area for us to liquidate these positions and then move into a more attractive opportunity. Another issue which we classify as an alternative investment is a structured note. And essentially, structured notes are a combination of a bond and a derivative, an option. And we worked and are working with several different investment banks to provide some exposure to these types of investments for our clients. The advantage to us is that we can continue to participate in a risky area of the market. The note that we used towards the end of last summer was in the Russell 2000, which is a small cap index, pretty volatile index. But we were able to structure, with the help of Goldman Sachs, the traditional risk-reward relationship in small caps. So essentially, we are participating in much of the upside of the small cap index, but we're doing so with a 25% buffer, downside protection. So if we're wrong, if that index does decline over the next few years, the first 25% of that decline would be covered, and clients would receive their principal back 100%. In addition to that, many of our income clients, we've used some option strategies where we're selling some option premium on some risky investments. That has the effect of taking some risk off the table, but also enhancing income. I mentioned earlier master limited partnerships. These are pretty unique vehicles. We can discuss these more if you have some interest. And then floating rate preferred stocks. Again, these are essentially a hybrid between a stock and a bond. The floating rate component of it means that should interest rates rise, the payout or the income that these instruments, securities issue would rise accordingly. So we think they're pretty attractive at this point in time. The next slide shows in a little bit more detail what's occurred with this structured note that we use through Goldman Sachs. The line in the middle is the performance of the Russell 2000 index. And you can tell it was high, it was low, it was high, it was low, now it's high again. It's a very volatile index. We initiated this position in August 11th of last year. This is right when the markets was really starting to break down. And you can tell even after we got into it, the market went down further for a small period of time. The initial level we started this position at was when the Russell 2000 was at 726. Today it's at over 800, so it's exceeded that initial level. The way our note is structured is that essentially 1 year, 13 months actually to be exact, 13 months after that initial date, which is September 18th, 2012, if the Russell 2000 is trading above 726.80, the note is called away and clients receive a return of 10.83%, regardless of where the index is. So with the index up at 800, we're fairly comfortable that can occur. If for some reason the market pulls back below that, the note continues for another 6 months, and then again it's another look-back period. If the index is trading above that initial level, clients receive their full return. And then again, the last call date is on 24 months from that initial period of time, so August 2014. August 2013 would be the last date. And on the bottom of that slide, it shows that represents the buffer level, the 75% of the value of the Russell 2000. So essentially, as long as this index is trading above 545.10, this is a pretty safe investment, and you should do no worse than 100% of your principal. If the index stays above that initial level, we have a nice return. So again, this is sort of the type of out-of-the-box thinking that we are using for clients right now, and it's directly a result of the fact that we don't see terribly attractive returns in traditional stocks and bonds. So we do think it's necessary to take the time to do the research and the due diligence to uncover some unique opportunities for our clients. And this is just a small example of that. In terms of where we go from here, I've touched on it just a little bit. We're pretty comfortable with how we're positioned right now. I mean, if you look at how our portfolios have behaved over the last several years, when the markets are doing poorly, we lost some money, but not nearly as much as the broad markets did. When the markets rally, we are participating in most of that upside, although not all. So in a volatile marketplace like we have right now, I think we're getting the best of both worlds. We're participating in most of the upside and avoiding a lot of that downside. And over a long period of time, I think that's exactly what our clients need to be comfortable. Long-term is really our focus. There's a lot of news that comes out in the short term, and sometimes it can be a big distraction for ourselves and for clients. And when that occurs, we try to always refocus what we're trying to achieve in the portfolios, and that really is long-term, after-tax, total returns that can meet your financial needs. And lastly, this goes into our strategy, which is to remain flexible and to remain responsive to opportunities when they present themselves. There's always a big list of asset classes that we have that we are following that we would like to have some exposure to, but really it comes down to at what price can you gain access to them. We talked about emerging market stocks for years in the office here, And it wasn't until just a few months ago that we added some concentrated exposure to emerging market stocks. And that has everything to do with the fact that we're very disciplined, and we want to shift the portfolio when we think the odds favor an attractive outcome. All right, the last few slides, we touched on how volatile the market has been historically and where it is today. This chart is a representation of a volatility index. It's a little bit of a complicated instrument, but essentially when that line is very high, like in the 2008 financial crisis, that's when markets are most volatile. And you can see points in time, the Greek and Euro debt contagion fears, which took place not too long ago, long-term capital management, 9/11. These are all times when volatility spiked. Where we are today is well below average. I hope we don't go back up to the levels of 2008 or even where we were with the Greek and European debt contagion fears, but I would be surprised if volatility stayed as low as it is today. And it certainly wouldn't be unheard of. And this last slide is an attempt to, from a research provider that we look at, it's an attempt to chart out how various areas of the bond market would behave in several different scenarios. So, our most likely scenario is a subpar recovery, and in that scenario, emerging market local currency bond funds would likely perform the best, and that's part of our rationale for owning them in our portfolios. In that case, the Barclays Aggregate Bond Index, Treasuries, heavily loaded in Treasuries, would do the worst. So again, we're avoiding that scenario. But you can see in other cases how, depending on how these scenarios play out, certain areas of the bond market will do better than others. The key to us is not to pick exactly which of these scenarios will play out. The key to us is to put together a strategy where no matter what the market does, there are periods in time when it looks like we're heading into a recession, or it looks like inflation is going to kick in. Is our portfolio able to weather that volatility and the ramifications of that? And it's a very complicated process because the future is unknown. But what we do is essentially weight all these different scenarios and try to arrive at a solution that performs best most of the time. And that's our mandate. That's what we try to do for clients. So I think that's it for now. If anyone had any questions, now would be the time.
Travis, if you have anything you want to add, now's the time as well. If anyone has any questions, just click the Q&A button on top and ask the question. If you can't think of it now, give us a call later on and we can help you out. Doesn't look like anyone has any questions, but thank everyone for their business. If you want clarification on anything in this presentation, just give us a ring. If you know anyone that might need help looking for income, who's looking for financial planning, who's looking for capital preservation, give us a call and let us know. We'd be happy to talk to them. And that's pretty much it.
So we'll look forward to being back with you at the end of the next quarter, probably the third week in July of this summer. And hopefully we will have some continued robustness to talk about. And as Travis says, if there are any questions or anything is unclear, by all means pick up the telephone and give us a call toll-free at 1-888-KRASNEY. That's 1-888-572-7639, or email info@krasneyfinancial.com. Thanks, everybody. See you soon.